as always, our Excel master, our data sponge, so to say, someone who I feel he's the most research-oriented, deep study-oriented individual I've met. And that is why it is so fun for me to do this.
Color correction, Mehul, I'm turning red.
But first and foremost, you're our AMFI registered mutual fund distributor, all right? And recently, you mentioned a very intriguing perspective, which is, imagine a scenario. You asked me to imagine a scenario where your credit card, all right? Where we're just paying the interest on the credit card, not even the principal amount, right? Like the interest. I know they have horrendous interest rates, but just the interest on a credit card. And that ends up costing us $1 trillion a year. Not a million, not a billion, $1 trillion. Matlab more than a lot of countries' ki complete GDP. What is the scenario you're asking me to imagine, Parth?
One, and second, I want to add two things here. One, it's a reality, and I'll be pointing out exactly where you can find this in the world. And second, you mentioned that we have horrendous interest rates. Even though the interest sounds big, the scenario in which we are talking about, the interest rates are low. And even despite lower interest rates, you have this humongous value, $1 trillion of interest payment.
Correct.
It does sound like a math error, Mehul, doesn't it?
Yeah.
Yeah, but it's the reality. If you and I had that credit card, we'd be bankrupt before even I could finish the sentence. The bank would seize the house, the car, even the office furniture. But when you are the United States government, you don't go bankrupt. You just change the rules of global finance.
Yeah, I mean, I think we would end up losing these suits as well, but they wouldn't. Not even a night's sleep.
Yeah.
So, it's staggering, this reality, and I feel it's almost double standards. Governments versus end consumer, and we're actually the ones funding governments, but we'll get to that later. And it also explains why, so many investors that I speak to, friends, family, relatives, they feel a very huge underlying sense of, unease. It's very uncomfortable right now to invest. Like, not even gold is a safe investment anymore, right? We crave permanence as human beings. We want stability, especially as Indians. That's one thing we're rooted. Get a good degree, get a good job, get stability in life. But we want to believe that the ground that we stand on is solid.
Yeah.
Is it?
I wish I could say that it is. But the way things are right now, I mean, even if we want to implicitly trust the financial foundation, because questioning it makes everything built on the top of it, like whatever you were mentioning right now, the homes, retirement funds, education, this and that, everything feels incredibly fragile, right? But when you look at the raw data, Mehul, the foundation isn't just shifting, it's being rebuilt in real time.
Correct. And that's exactly why we're here today, right?
Yeah.
We have a massive stack of sources to unpack. Geopolitical shifts, macroeconomic trends, and some hardcore 28-year historical data from the Indian stock market.
Right.
What is our mission for our listeners today?
A lot of times we hear this headlines, this news, and at times we wonder, does this even relate to me? Like, how am I being affected? So our mission is to draw a straight line from the shifting stance of global superpowers right down to the daily reality of your wallet. We want to connect the big world of debt and tariffs to the personal world of protecting your purchasing power, because that ultimately is how you will truly build your own wealth.
Correct. So basically answering the question, do tariffs actually affect the end consumer? We're going to try to draw that line today.
I hope someone also understands it before putting it on.
Okay, now let's start with that chaotic feeling that is on every headline today.
Yeah.
Okay, tariffs, geopolitical flashpoints, wild market swings, all on the basis of a single tweet. It's easy to feel overwhelmed. I'm sure all of us are feeling overwhelmed, not just big financial investors, portfolio managers, asset managers, but even the end consumer investors, like, your average intern who's just saved up 10,000 and invested them in stocks. They are also feeling overwhelmed. How do we separate the panic from the signal?
I understand that we want to talk about how do we separate the panic from the signal. But I also want to empathize with the fact that there is panic.
Correct.
Because we have a certain comfort level. For the last couple of years, there is this US dominance, which has been the default setting, and we are in that comfort zone. And whenever something changes, people are like unsettled by it, right? So, to actually differentiate the signal from the noise, we will have to understand the mechanics.
Okay.
Right? We'll have to see how the tariffs are being used as constant leverage. And there is friction between the traditional allies like NATO and the EU, and the foreign policy regarding oil-producing nations from Venezuela to Iran. Everything is very volatile, but once we have the clarity, once we have the understanding, I think we'll be able to separate the panic from the signal.
Correct. And even, internally, we see a lot of pressure that exists currently on the Federal Reserve. So does this unpredictability also show up in the hard numbers there?
It does. And Mehul, it's terrifying.
Okay.
The US debt burden is now approximately $39 trillion. To put that into perspective, the fiscal deficit is 1.83 trillion, but the most staggering figure is the interest payment alone. As we mentioned, it's eating up around 1 trillion of US budget every single year.
The credit card. Finally.
Yeah, but it's not an imaginary scenario, it's a reality.
So the US government is paying 1 trillion
in interest payments every single year, and that's going to go on increasing from here.
Well, going back to the same analogy, the US, so-called the only bank, the father of all banks, the mother of all banks, the chachi of all banks. If people get that reference, please comment. But the bank manager, so-called here, the government, is acting very, very erratically, and it's drowning in debt. But why does the rest of the world, every other country, still keep using their currency?
That's how the way it has been, Mehul, for decades now, because that's the reserve currency advantage which the US has. The world needs dollars to function, buy oil, to trade, to settle international contracts, and this is often called the petrodollar system.
The petrodollar system.
Yeah.
Can you explain that loop for us? How does it work?
So Mehul, it's a closed system. The US provides security to oil-producing nations. In return, those nations price the oil exclusively in US dollars. They take those massive dollar profits and buy US treasury bonds. Essentially, they feed the debt machine. It's why there has been such intense strategic interest in nations like Libya, Iraq, and Venezuela over the decades. It guaranteed a permanent, massive demand for US debt.
Correct. And that's been the case so far. But you're saying that loop is now vulnerable, it's breaking?
It appears to me that the loop is breaking. When the US uses the dollar as a stick rather than a carrot, using things like tariffs for short-term signaling, other nations start looking for the exit, right? They realize that if they depend only on one bank in the town, then they're at the mercy of that bank manager's whim.
Correct. You also mentioned that while tariffs is what actually gets all the headlines, the news articles, the news coverage, there's a deeper battle that's happening over microchips, and you call it the new oil.
Yeah.
What's that?
Precisely, Mehul. So in last century, if you control the oil, you control the economy.
Correct.
In this century, in the 21st century, if you control the advanced semiconductors, you control the future. By restricting who can buy or manufacture these chips, the US is essentially trying to ring-fence the technology of the next century, and just the same what they did with energy.
Right. And what is the side effect of all of this aggressive posturing that they're doing?
It's a total breakdown in trust. The turning point was the onset of the Russia-Ukraine war.
Correct.
Looking strictly at the financial mechanics, over $300 billion in Russian foreign exchange reserves, held in dollars and euros, were frozen almost overnight.
Okay, let's pause. 300 billion.
Yeah.
Wow. How does that actually happen? It's not like they sent the army or troops to a bank and a vault and just seized it. You can't enter, this is now ours. How does someone freeze $300 billion worth of cash?
It's the terrifying realization of the global central banks. Those reserves, Mehul, are just digital entries on a ledger controlled by Western financial institutions. With one click of a button, that money effectively vanished. The realization was stark. If your national reserves are digital and controlled by another nation, they aren't truly yours.
So is that why we're seeing a gold rush among central banks? Like everyone is buying their gold, everyone is bringing their gold back from foreign wallets into their own wallets?
Exactly. China, Russia, emerging markets are aggressively holding physical gold. This isn't about looking for good quarterly return, it's about survival now. It's about the tail risk protection.
Okay. Because gold is a bearer asset.
Yeah, so if you hold physical gold in your own national vault, there is no counterparty risk. No one in New York or London can push a button and freeze a physical bar of gold in Beijing or Mumbai. Gold shines when trust breaks.
Fair. I'm sure my mom, my nanny, all of them are going to be very happy that they hold physical gold in their vaults.
And thanks to them, we all have doubled our assets over the last 1.5 years.
I swear. Until the last month, but still. Over the last few years. Okay, let's talk about the other metal, which as Indians, we still love investing into, you know. It's our go-to for shaguns. It's our go-to for every kind of celebration. Silver. All right. We hear so much about it. And the headlines say that forget jewelry, forget traditional applications. Silver is very crucial for solar panels, electric vehicles, AI. Is that a completely different story, or does that also go hand in hand with gold?
It doesn't actually. Silver is very different. It behaves differently from gold. And many investors are being told to buy silver for the green energy transition. But the data tells a different tale. While the narrative is loud, actual industrial demand for silver is currently flat or down.
Wait, you're saying demand is flat industrially, but still silver has been on a rally.
Yes.
Right? It hit a all-time high in a couple of months ago at 4 lakhs per kilo in India. What is driving this price spike?
It's the hype. It's the pure financial momentum.
Okay.
You see, silver is primarily a byproduct. It's mined alongside zinc, lead, and copper. Miners can't just decide to mine more silver. They get what they get when they mine other metals. Because industrial demand isn't the driver, the price is being pushed by investment demand, specifically the ETF flows and the short covering.
Okay, you need to simplify that for noob, beginner investors such as me. What is short covering?
So imagine a trader bets that silver prices will drop, but then a wave of hype pushes the prices up. The trader is now trapped. They are legally obligated to buy back the silver to cover their losses, which then pushes the price even higher. It's the artificial spike.
Okay, and the ETFs?
Well, it's just like a snake eating its own tail. A retail investor hears about solar panels, buys a silver ETF on their phone. Because they bought the digital share, the fund is legally forced to go into a physical market and buy actual silver to back it up. This squeezes the supply. The prices spike. More headlines are written, more people buy the ETF. It's a speculative feedback loop that has almost nothing to do with how many EVs are actually rolling off the assembly line.
Interesting. So, to extrapolate from this, nations are buying gold for survival, speculators are playing with silver, but what about a regular listener like me? What do I do? Right? Holding gold bars in my basement or hiding them in my gadda is not exactly a retirement plan, right?
I didn't know you had a basement, Mehul.
Well, let's just say gadda. For most people living in Mumbai, gadda is basement enough. Go on. Is that a retirement plan?
I feel for the individual, the biggest threat isn't a geopolitical collapse, it's the inflation. I love when Warren Buffett quoted, the inflation tax is a fantastic ability to simply consume the capital. It's the silent tax.
Okay. It frames the dual risk every investor faces, right? Short-term risk versus long-term risk.
Short-term risk is volatility, the gut-wrenching feeling of seeing your portfolio drop on a Tuesday. But long-term risk is much more dangerous. It's the erosion of your purchasing power to nothing. As Robert Allen says, no one gets wealthy by just parking money in a savings account. A savings account guarantees you, but you will slowly bleed to death from inflation in the long term.
Okay, and to beat it, you've brought some incredible data regarding the Indian market, I understand?
I have.
Tell us about this 28-year-old study with the one and only Nifty 50.
So this is the ultimate stress test. India has been one of the most dynamic, high growth and volatile markets over the last 3 decades.
Okay.
If you invested 1 lakh in Nifty 50 at the start of, let's say, 28-year period, do you know what it will grow to today?
I'm very eager to hear.
Well, approximately that 1 lakh will turn to 24.6 lakhs. That's a 12% CAGR return. you multiplied your wealth nearly 24 times over these last 28 years.
Wow. But what about that silent tax that you were speaking about? How does that affect my real return?
Very smart question there, Mehul. After factoring in the inflation, the study shows that 8.7% is the real rate of return. That is only the metric that matters. It's the difference between keeping your head above water and building generational wealth.
Okay. So if the math is clear over here, 12.1% over 28 years, why isn't every investor wealthy? Why do people panic even today?
Because they don't get wiped out by the market, they wipe themselves out. They can't handle the volatility. In those 28 years comprising of 6,900 odd trading days, do you know how many times the market has had a correction?
28 years, I don't know, 10, 20 times?
43% of the time. Almost half of the time, you are technically losing money on paper, notional loss. Drawdowns happen in negative years, flat years, and even in wildly positive years. This triggers loss aversion bias. The psychological pain of losing 100 is twice as strong as the joy of making 100.
And that I can attest to for sure. So people basically like us, the retail investors, they try to time the market, ride the wave up. And they say, I'll sell now and I'll buy back when it's safe, correct?
No one has ever been able to do it consistently, and that is the single biggest destroyer of wealth. The data proves that absolute best days in the market are tightly clustered right next to the absolute worst days.
Okay, can you give me an example?
Sure, Mehul. Look at 2008, the global financial crisis. From January 2008 to March 2009, the market was in a 50% free fall. It felt like the end of the world. Yet, right in the middle of that panic, we had some of the highest returning single days in the history. Jumps of 6%, 7% out of nowhere. Or look at the COVID drop in March 2020. On March 23rd, the Nifty dropped 13%, but just a few days later, on 7th of April, it shot back 8.7%.
So what you're trying to say is if you're out of the market and you're trying to play it safe, wait for all the dust to settle, you're actually missing the recovery?
Waiting for the dust to settle is the biggest mistake you can make. And the cost of making that mistake is devastating. Let's look at the math again. If you stayed invested for those 28 years, you got 12% return. Now, if you try to act smart and you just try to stay out of the market, but while doing that, you miss just the top 10 best days out of those 6,900 days, your return drops from 12% to 5%. And I'm talking about 28 years.
So if you miss 5 days...
10 days.
Oh, sorry. If you miss 10 days from 6,900 days...
Yes.
12 to 5%.
Yeah.
You lose more than half of your wealth.
Absolutely.
Just by missing those 10 days.
It completely destroys the compounding effect. It's like a pilot making a 1-degree error on a long flight. You don't notice the turn, but hundreds of miles later, you have completely missed your destination. To succeed, you have to accept that drawdowns are the toll you pay on the road to your financial freedom.
And I was happy when Mumbai abolished the tolls and vehicles entering in and out, but shit, man, this is everywhere. So, okay, we've covered a lot, Parth, from the $39 trillion US debt to the toll of the market volatility, which is almost like Vashi Bridge. To wrap up, what's the new thought that you want to leave us with?
Mehul, there is one thing which drives the financial markets. It all boils down to trust. The trust free in dollar is leading to gold holding. We have seen that the trust in cash is broken by inflation, leading to equity investment. But what happens when the next generation decides to place their trust in code?
You're speaking about tokenization and blockchains, right?
Yeah. If trust is removed from human institutions, central banks, stock exchanges, and placed into transparent blockchain code, does volatility then disappear? Or does it take on a terrifying new form where algorithms panic faster than humans ever could?
It's a profound question, right? Is a code a stronger foundation or just one that we don't fully understand yet?
That is sure something to think about, Mehul. But for today, the lesson is very clear. Align yourself with the one mathematical certainty of long-term compounding and stay the course through the storm. do not miss those 10 days out of those 6,900 days. If you do that, you will end up destroying half of the wealth you could have created.
Correct. Basically, don't get caught napping.
Yeah.
Thank you, Parth. Thank you for this deep dive. It was a very interesting conversation, starting from, well, $1 trillion credit card bill, coming down to how do we survive in this volatile economy or volatile market, so to say. And it's been eye-opening. So thank you very much, Parth.
Thank you so much, Mehul, for having me here.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. The information provided in this discussion is for general awareness and educational purposes only and does not constitute professional financial advice. Past performance is not an indicator of future returns. Please consult with your finance professional before making any investment decisions.